In this lesson, I'm going to walk you through one of the core ICT day trading principles that, in my opinion, every consistently profitable trader should integrate into their approach. We're not just going to cover a simplified strategy, I'll also share with you a complete trading framework you can begin applying immediately, along with several examples to see it in action. The focus here is on understanding the price of 3 or PO3 and how candle dynamics work in the context of ICT methodology. This concept is absolutely vital if you're aiming to trade intraday with precision. Let's break it down step by step. Imagine we're looking at a bullish daily candle. On such a candle, we have four key reference points: the opening price, the closing price, the highest price reached during the day, and the lowest price. When the day is bullish, one of our main objectives is to pinpoint where the market formed its daily low. In other words, the bottom wick of the candle. The big question is, can we position ourselves as buyers below the opening price and essentially catch that wick before price rallies higher? To do this effectively, the first step is to mark out the Asian session range. In ICT's framework, the Asian session runs from 7 p.m. to 12 a.m. Eastern Standard Time. Many times this period forms a consolidation range, and this is one of the two main daily profiles we observe in ICT's approach. Understanding this structure allows us to anticipate where the low of the day might form and align our trades accordingly. In most cases, when we look at an Asian session range, the market tends to go into consolidation. This usually happens between 7 p.m. and 12 a.m. Eastern Time, where price action is often slow and contained. What's really happening during this phase is that the market is setting up orders both above and below that range. In other words, liquidity starts to build up on both sides. With this in mind, the next step is to watch what happens as we move into the London session, or sometimes even during the New York session, depending on the overall daily structure. Very often the market will make a sharp move, typically pushing down below the Asian session's low. When that occurs, the key thing we want to see is whether price is reacting at an important, higher time frame level. This could be a level from the previous day, or one drawn from the weekly, daily, or even 4-hour chart. The time frame doesn't matter as much. It's about whether price is tapping into one of those meaningful zones. Later on, I'll walk through clear examples of this so it makes more sense in practice. Let's imagine price reaches an important level, say a 4-hour order block. At that point, what we want to see is some kind of lower time frame setup or a clear sign of displacement. So, what does displacement mean? In simple terms, it's what happens after a stop run into a major level. Usually the market reacts with a sharp reversal, often breaking above a swing high, and this movement tends to leave behind a fair value gap, an imbalance on the chart. Once that imbalance forms, we can look for price to pull back into it, giving us an opportunity to enter in the direction of the new move. In a bullish scenario, this means waiting for the market to dip back into the imbalance before continuing higher. Ideally, the day ends up closing strong, sometimes with the high of the day forming around the London close before price consolidates again. The key point here is that we don't want to jump in too early. Buying right at the low can be aggressive and risky. Instead, the sweet spot is after displacement, when there's already been a clear move and enough room left in the daily range to capture a solid trade. Now that we've looked at the bullish setup, let's flip it around and talk about the bearish version. The concept is the same, just in reverse. When analyzing a bearish daily candle, we've got the high, the open, the close, and the low. What we want to anticipate is the candle's high being set. Typically, this forms during the Asian session consolidation, which runs from 7 p.m. to 12 a.m. Eastern Standard Time. After that range is established, the market often pushes higher into a key higher time frame level. This could be on the 4-hour, daily, or even weekly chart. Once price tags that level, we're looking for displacement again. In a bearish scenario, displacement often comes with liquidity being taken out and followed by an aggressive move down. This breakdown usually clears structural lows and leaves behind imbalances. These imbalances are important because they act as key reference points for pullbacks. From there, we look for the market to start forming classic bearish structure, lower highs and lower lows. Initial downside targets could be the Asian session low or sometimes a more significant level, like a higher time frame fair value gap on the 4-hour or daily chart. The whole purpose of this profile is to align ourselves with the larger move and get in sync with the market. That's why candle dynamics matter so much. My trading approach, and the reason I've been able to scale it successfully, is built around anticipating how daily or even weekly candles will form. This framework is the foundation for doing just that. So, what time frame should we use for this kind of setup? Personally, I like to focus on 3 options depending on the context: 5 minutes, 15 minutes, or 1 hour. If you want to be a bit more conservative, the 15-minute and 1-hour charts tend to work best. They give you a good balance of clarity without too much noise. The 5-minute chart can be useful for more precise entries, but it does come with the risk of being shaken out. That's because when price first taps into a key level, it may pause, consolidate, or distribute before making the real move. On a lower time frame like M5, that choppy action can easily stop you out before the bigger trend unfolds. All right, let's move into some real chart examples. Here we're looking at pound. First, let's talk about why I was bullish on this day, because narrative is key. On the daily time frame, the market had dropped into a fair value gap. From that level, we saw a strong reaction, what I'd call a clean displacement move, where price pushed higher and closed above the prior bar. From there, my expectation was for the market to push into new highs and expand further. So that's my narrative starting point. I always begin with the daily, then step down to the 1 hour, and so on. By the way, I've got a full video on my channel that goes deeper into this top-down analysis process. A clear swing low, followed by a swing high that broke above a previous high. That break confirmed a market structure shift to the upside, which gave me the green light to start refining my entry idea on lower time frames. The market had dropped into this fair value gap, and the reaction was strong. A clean displacement move where price pushed aggressively higher and closed above the prior bar. That kind of price action essentially creates an order block, and from there my expectation was that the market would continue to push into new highs and expand further. After that, price pulled back into a fair value gap, then launched with another impulsive push upward. Inside that structural move, from swing low to swing high, the question becomes, where are the key levels? We can highlight the bullish fair value gap, or alternatively, we could map the move with a Fibonacci retracement from low to high. That way, we look for potential retracements to the 50% level. Sometimes the market comes all the way back down toward that midpoint, and other times, if there's a strong level, like the fair value gap in play, price holds above 50% and continues straight toward liquidity. This is where the timing element matters. It varies case by case. Now let's step into the lower time frames and look for the PO3 concept in action. Remember, our goal is to anticipate a bullish daily candle and look for entries around the wick low. On the 1-hour chart, I plot the Asia range, then drop down to the 15-minute chart to play this forward candle by candle. As price trades into our key level, here's what I want to see. A liquidity sweep, run on stops, followed by displacement, and that's exactly what happens. The market takes out the prior lows, then shows displacement within the right time window at our key level. That combination, key level plus liquidity sweep plus displacement, is my confirmation to look for longs, with the expectation that we've likely formed the low of the daily candle. Playing it forward, price expands and shifts above prior highs, confirming that displacement push. At this point, there are 2 ways to enter. 1. Place a limit order around the imbalance, buying the pullback, or 2. Enter on the breakout candle close after liquidity has been swept. In this example, if you took the FVG entry, here's how I'd manage risk. The stop loss goes just below that FVG candle. From there, price never retests the level. It just continues to expand higher, pushing into new highs in line with our daily bullish narrative. Back to this trade, as price continues to expand, we start to see fair value gaps forming. At this stage, some traders might choose to move their stop to break even, but for this walkthrough, I'll just let the trade play out. The result? A clean 6 reward trade, all built on the exact concepts I've been showing you. Remember, the main goal is simple: to time the wick low of the daily candle using this framework. When you catch a liquidity sweep at a key level during a key time window, and it's confirmed by displacement in the direction of your higher time frame narrative, you put yourself in position for some of the most profitable trades you'll ever take. I hope you found this example valuable. Don't forget to subscribe because I've got a lot more content like this coming. And if you'd like me to cover daily profiles, ICT concepts, SMT, or really any trading strategy in detail, let me know down in the comments. I'll see you in the next video.